Welcome back, and it's time for the Word on Wall Street. Top investors watching your money. Joining me right now is Michael Lee strategy founder, Michael Lee, and with us all morning long, Chris Markowski. Great to see you, Mike. Thanks for joining the conversation. Chris, kicking things off with you here because we are looking at markets that are higher this morning ahead of an important meeting tomorrow on debt and ahead of a big week of retail news. Home Depot, Target, TJX, Walmart, all reporting quarterly earnings this week. We'll also get the April retail sales number out tomorrow morning. Economists are expecting to see an increase in sales of 0.7% month over month, Chris. What do you think this is going to tell us, and how important is the retail sales number for investors? Because it does give us a good window into the consumer, right?
Oh, absolutely. And we talked about this last hour. We had the Bank of America's credit card report come out and starting to show some weakness, not just in the middle to lower sector, but also the upper sector as well. Again, investors right now, they're taking in a bunch of information. You had Stanley Druckenmiller at the Sohn conference last week talking about more dead bodies coming down the pike. Yet you had Warren Buffett talk about his situation and how well he's done. I would encourage investors right now. Listen, you're a long-term investor. I'm going to quote Warren Buffett. Okay, when others are fearful, you need to be greedy. It's smart. You want to look to take anti-fragile companies, high-quality companies, understanding that compounding is the royal road to riches, companies that are paying dividends, and you'll come out on this the other side. This is the most widely predicted recession, supposedly, that's coming down the pike. If it comes, great. That's when the market's going to start taking off again.
All right, Mike, your thoughts? And what about the budget talks? Inching forward, President Biden and House Speaker McCarthy planning to meet again tomorrow. Markets are rallying this morning. Is that on some optimism that a debt deal could be imminent?
Yeah, I'm not sure how these debt talks are going to play out. I'd imagine there is some sort of negotiated settlement. But I would say we are in 0% chance of default. There's more than enough money coming into the Treasury to cover interest on debt, Social Security, Medicare, and the defense budget with a little bit of money left over. So if there is any sort of structural default, it is 100% the choice of the Biden administration and Treasury Secretary Janet Yellen. And I think the trading around this is theater and somewhat nonsense. Nonetheless, it's dominating the headlines. I would say, looking into these retail earnings and the retail sales that are coming out, I'd be looking, first of all, in retail sales at the revisions, because we've seen a lot of revisions from everything coming out of the BLS, and there's seasonal adjustments with half of the job growth over the last 12 months from their birth death statistical adjustment, not real jobs being created, simply just moving numbers around a spreadsheet. I'd look for more of that chicanery in this retail sales number coming out. But you are starting to see some cracks in the surface of the upper end spending, as Chris just mentioned from the Bank of America credit card report. So what are we going to hear from Walmart, Target, Home Depot, Lowe's about things going forward? What does their guidance look like? Because we've started to see cracks in the labor market over the last few weeks, with the weeklies jumping substantially, and then starting to see some higher continuing claims. Is that rolling over into the higher end consumer that is really fueling our economy? And even though we have seen earnings declines year over year and these talks of recession, you haven't really seen that flow through to the consumer, even though consumer sentiment is at below where it was during the depths of the pandemic. So, I'm looking to see what you're hearing going forward, and given all the drama in the banking sector, with the bank failures we've had and the stress that we've seen throughout the industry, the contraction in credit conditions, that is going to spill over to the economy. I would say a recession is unavoidable, with everything in the plumbing of the financial sector looking very similar to 2008. I think the key difference is, though, it's not because these banks own toxic assets. It's because you're seeing a deposit flight out of these banks, and no bank can handle a run on the bank. So I don't know that this will be as calamitous as 2008, but it's hard for me to see us avoiding some type of recession. Maybe it's shallow, maybe it's a little bit deeper than a shallow recession, but credit conditionings are tightening across the board. That has historically led to a recession 10 times out of 10. So we'll see where we go from here. Equities may soldier through, or if you do see some big sell-offs, as Chris mentioned, it's an opportunity to go bargain hunting for people that have more than, say, a 6-month time horizon.
Yeah, and I'm glad you mentioned the banks. We spoke with Robert Kaplan last week on this program on Friday, the former president and CEO of the Dallas Federal Reserve. And he said that right now, small banks are struggling and small business is struggling. Remember, the regionals lend to 90% of small business. And this week's a big week for this because on Wednesday, the House Financial Services Committee will host the executives of Signature Bank as well as Silicon Valley Bank. That happens Wednesday at 10 a.m. And then on Thursday, bank regulators will testify before the Senate Banking Committee. That begins at 9:30. But probably the biggest meeting of the week is tomorrow's debt ceiling meeting. TD Cowen is writing about it today. They say that there are 3 issues that are forming a potential term sheet, which could come out of a broader debt deal: the clawback of unspent COVID-19 funds, energy permitting reform possible, both fossil fuel and green, and caps on future discretionary spending growth. That's the expectation from the analysts at Cowen and Company. Do you think we could get a deal, and would the markets react positively to that? First you, Chris.
Oh, I think they'll react positively, but I agree with Mike 110%. It's all a show, this entire thing. There's more than enough money coming in. What Janet Yellen's been doing is deplorable, but they did it. I mean, John Kerry did it back in, 2011, if I'm not mistaken.
Yeah. Real quick, Mike, you think a deal will happen?
I don't think so. I think the Republicans hold all the cards here, and I think we've seen very much a new Kevin McCarthy since January, and I hope he digs his heels in and gets some meaningful spending cuts here because we are $32 trillion in debt, not including the $8 trillion on the Fed balance sheet. It is we are in dire straits, and something needs to happen.
All right, Michael Lee, great to see you. Thank you. Chris, you're sticking with us all morning long. We're happy about that. Quick